Welcome to FX Tech's weekly analysis. This is our NZD/USD report for the week of December 15th to 19th, 2025. In the coming minutes, we'll break down the key fundamental drivers, technical levels, and strategic outlook for the Kiwi dollar. We'll explore the conflict between New Zealand's surprisingly strong domestic economy and the headwinds from a strengthening US dollar and weakening global risk sentiment. Stay with us as we navigate this complex market and identify the key trading opportunities and risks for the week ahead. Let's get started. This week, the NZD/USD was a market defined by indecision. The pair remained trapped in a tight consolidation range, struggling to overcome critical resistance around the 0.5800 level. This stalemate is a classic case of conflicting forces at play. On one hand, New Zealand's domestic economy is showing remarkable strength, with business confidence hitting a 30-year high. On the other hand, a firming US dollar and a broader risk-off mood across global markets are capping any potential upside. The price is technically squeezed between the 50 and 200-day moving averages, signaling that a significant move is on the horizon. The story of the week was a tug-of-war between stellar domestic news and cautious global sentiment. New Zealand delivered a trifecta of positive surprises. Business confidence soared to a 30-year high, the trade deficit narrowed dramatically, and Q3 GDP growth beat expectations. Ordinarily, this would be a recipe for a strong Kiwi rally. However, these bullish signals were neutralized by external factors. The Bank of Japan's rate hike created market uncertainty, and a strengthening US dollar, fueled by tempered expectations for Fed rate cuts, kept risk appetite in check. The result was a market that simply couldn't find direction. Fundamentally, the NZD/USD is caught between two opposing narratives. The domestic story is incredibly strong, business confidence is booming, export growth is solid, and inflation expectations are stable, giving the RBNZ a supportive stance. This provides a solid floor for the currency. However, the international picture is less rosy. The Federal Reserve seems hesitant to cut rates as quickly as the market hopes, creating a policy divergence that favors the US dollar. This fundamental conflict is the primary reason for the current market stalemate, capping the Kiwi's upside potential despite its strong domestic credentials. From a technical perspective, the NZD/USD chart is screaming indecision. The price is currently squeezed in a compression zone between the 50-day EMA, which is acting as support, and the 200-day EMA, a formidable resistance ceiling. The long-term bearish death cross pattern remains in effect, yet the price has been unable to break down decisively. Analysts have described the current price action as a mess, suggesting the market is overextended and consolidating before its next major move. A breakout from this compression zone is imminent and will likely be volatile. For traders, understanding the key technical levels is crucial in this environment. The most important zone to watch is the resistance ceiling between 0.5800 and 0.5830, which includes the 200-day EMA. A breakout above 0.5850 is needed to confirm bullish momentum. On the downside, immediate support lies at 0.5750, which is reinforced by the 50-day EMA. A break below this level would open the door to 0.5700 and potentially the major medium-term floor at 0.5600. These levels define the battlefield for bulls and bears in the coming sessions. Our short-term outlook for the next 1 to 2 weeks is cautiously bearish. The repeated failures to break the 0.5830 resistance level suggest that sellers currently have the upper hand. Combined with weakening global risk sentiment and a firm US dollar, the path of least resistance appears to be to the downside. We anticipate a trading range between 0.5690 and 0.5830. A decisive break below the 0.5750 support level would likely act as a catalyst for further selling, especially with holiday-thinned liquidity potentially amplifying market moves. Looking out over the next 1 to 3 months, our outlook becomes more neutral. The exceptionally strong domestic data from New Zealand provides a fundamental safety net that should prevent a currency collapse. The prospect of a robust economic recovery in 2026, with a supportive RBNZ, creates a stark contrast to the Federal Reserve's easing cycle. This policy divergence should limit the downside. We expect the pair to trade within a broader range of 0.5600 to 0.6000 as these powerful, conflicting fundamental drivers battle for control. There are significant risks to both sides of the trade. We see a 70% probability of downside risks materializing, driven by sustained US dollar strength, a further deterioration in global risk appetite, or a technical break below 0.5750. On the other hand, there is a 30% chance of an upside surprise. This could be triggered by continued stellar economic data from New Zealand, a sudden dovish pivot from the Fed, or a technical breakout above 0.5850 that forces short sellers to cover. Traders must be prepared for volatility in either direction. In conclusion, the NZD/USD is at a critical juncture, and patience is the key to successful trading. The market is in a stalemate, caught between strong domestic fundamentals and challenging external conditions. Our short-term bias is cautiously bearish, while our medium-term view is neutral. The most prudent strategy is to wait for a clear, confirmed breakout from the current compression zone. Watch for a close below 0.5750 to signal a move lower, or a sustained break above 0.5850 to confirm a new bullish leg. Until then, risk management is paramount.